Kriti Chawla and Assistant Director Sara Javed. CCIT is dedicated to dissecting contemporary fiscal matters on both local and international fora. And it presents a nexus of academic brilliance dedicated to dissecting fiscal contemporary matters and foster a vibrant discourse, robust debate and insightful discussions surrounding matters of domestic, international and comparative taxation. Through their combined expertise and dedication, the members of Center diligently engage in wide spectrum of activities including technical research, public consultation with other academic endeavors. So now that we have a glimpse of a remarkable CCIT, I would like to turn our attention to today's agenda for the presentation. The topic for today's lecture is Uncanny Similarities in the Development of Income Tax in India and United States of America between the time span of 1860s till the present day. So as the title suggests, the focal point of our discussion will be to draw intriguing parallel between the development of income tax in India and United States between the time span as I've mentioned, and delve into the parallel that shaped the taxation landscape in these two nations. So, in order to expand on the topic, we have our guest lecturer, Professor Archie Parnell. And Professor Archie Parnell brings with him a wealth of experience and stellar career trajectory that speaks volume about his contribution in the legal and financial sector. From his esteemed tenure to U.S. Department of Justice and U.S. House of Representatives to the leadership role at Exxon Corporation and Goldman Sachs, Professor Parnell has left an indelible mark on the global stage. His expertise extends beyond border, as evidenced by his engagement with organizations such as American Chamber, the OECD Business and Investment Advisory Committee, followed by teaching in the University of South Carolina and imparting his knowledge in various other conferences. So I would like to call Professor Archie on the stage to discuss about the topic.
Thank you very much.
It's not working.
Just this one? Okay. Thank you very much for that introduction. I appreciate it. It always sort of amazes me when I hear all of that sort of thing because to me, my life is kind of short. You know, and the way she described it, it's a very long life, but it's good. I mean, I've enjoyed myself. Thank you so much for being here today. And I also want to say my wife is here, which is unusual. She has not been to a lecture that I've given ever. The only reason I think she is here today is because we're going back to the airport this evening and she wants a ride. So she's coming. We've had the opportunity to have a very fruitful few days here. We've gone to the Taj Mahal in Agra. We've been to Mathura, to the temples there. We've gone to the Jammu Mosque in Old Delhi. And it's really, really very, very clear that the people are, it's hard to describe. It's so busy and so active. It's contradictory at times. It's boisterous. It's blustery. But at heart, it's very, very, very alive. And that's what India is, very, very alive. Yesterday, we also had the opportunity to go to St. James Church, which is a Christian Protestant church built in 1836 in Delhi, near the Kashmiri Gate. You know, the history here is redounded with so many things and so many tragedies. Now, as was described, this lecture is taking the time span from 1860 to today, and it's going to cover the United States and India, and it's going to do that in an hour. So I think a lot of you might think that this is an April Fool's joke because it's such a broad lecture and it's too broad to describe with any sort of specificity. Today, if you take your classes, you're talking about current law, you're talking about possible future law. You will have some references to the past, but not look too deeply in the past. Most conferences are forward-looking. There was a conference just this weekend at the Taj Mahal Iman Singh Hotel where they were looking forward. But the reason I have this photograph as the first slide of the lecture, this photograph is taken outside the National Archives in Washington, D.C. The archives take up the block between Pennsylvania and Constitution Avenue. This is on the Pennsylvania side. And you'll see, if you can see the engraving at the bottom, it says, "What is past is prologue." And I do think that, especially as I get older, it is becoming more and more apparent to me, looking in the past and trying to glean lessons for the future from the past is very, very important. Obviously, we have to live in the now, and you can't always live in the past, and you shouldn't live in the future and all that. You've got to live in the now, but you can take lessons from the past. And so this is not an April Fool's practical joke. It's not that. Well, we need to talk about how these laws have developed and why they have developed. Now that's so this is the broad topic that we'll be talking about in timeline. India on the left and the United States on the right. And you'll see that we start with the 1860 income tax here in India. We'll talk about the 1862 Civil War income tax in the United States. Talk a little bit, and I'll be focusing most of my time on those two items and comparing them. And then we'll just touch briefly on some of the topics in the middle. And then we'll end the lecture talking about the current discussions on Pillars 1 and Pillars 2, the OECD, the UN, and all of that, how the United States has approached that, and how India has approached that. And we'll have some concluding remarks from our colleague here that's with us today. So, getting straight into it. Now, those of you, I'm sure, that have studied history here know of the revolt of 1857. Show of hands? Okay, everyone. Good, good. Now, in England, that's called not the revolt of 1857, it's called the mutiny of 1857. But because of that conflict, there was a tremendous deficit that was recorded by the British government when they were trying to help the British East India Company. And that deficit had to be somehow addressed. Now, as a result of the conflict, that actually ended the British East India Company as such, and the government was formally changed from the East India Company to the British government control. And so that's what happened at that time. Now when the government of Britain looked at their resources for this area, they estimated they would face a deficit of about, at that time, £9 million, which doesn't sound like a lot today. I mean, that's still a lot of money, but I mean, it's not like a huge amount of money today, but back then was a very significant amount of money, and that was from the revolt in 1857. And Lord Palmerston chose a man by the name of James Wilson. Have any of you heard of James Wilson? James Wilson was one of the co-founders of the magazine The Economist, which is published today and is a very well-known publication. But Lord Palmerston in the 1860s chose James Wilson to become, if you will, the finance member of the Viceroy and his council at that time. and with the view that he wanted him to develop a finance plan to somehow address this deficit. You see, I'm going through a lot of pages because I'm not going to talk about all of this. Now, Wilson had many, many choices about what he could choose to raise revenue in India, and he refused to raise, for example, the salt tax. And, you know, it was an indirect tax that was very easy to collect, but he realized that the poor would bear the burden of that tax, and we all know that Mahatma Gandhi chose to use it as his focus of the first nonviolent protest against British rule, the Salt March. What James Wilson thought was that equal and just taxation required that taxes be spread as widely as possible, and that contributions should be conscious rather than indirect and not conscious. So what he chose to do at that time was probably what we would have all done coming from the UK, because the United Kingdom at that time had an income tax. And so he looked at, and it was just a fairly recent income tax because I think it started in 1810 and then it was repealed, but it came back in 1842 and thereabout. And so that's his time frame. He's aware of the UK income tax, and so he spent most of his time tinkering with the UK income tax, and he used that as his model to develop the mechanism to raise the revenue to address the deficit caused by the revolt of 1857. And he proposed this widespread income tax. Now, Lord Canning, who was the first viceroy of India, and he was the viceroy from 1858 to 1862, and he's quoted to saying at that time, when considering all of these ways to raise revenue, he said, and I'm quoting here, let me read this, get it closer so I can read it. He said, "Danger for danger, I would rather risk governing India with an army of very few men than I would risk having to impose unpopular taxation." I mean, so that's a pretty broad thinking person. I mean, he's saying, I could have many, many people in an army, or, you know, and have unpopular taxation, or I could have very few people in the army and have popular taxation. And so he was very concerned about imposing something that would be unpopular. But on July 19th, 1860, Joe Wilson reported back to the UK, or back to a friend of his in the UK, that, as he called it, my income tax is now law and will begin collection on salaries and dividends next week. I managed to get it through the Legislative Council without a single division and without giving up 1 point of importance. Now, as it so turns out, that happened to be James Wilson's last letter home, because his health was failing, and he decided, it was decided for him that he needed to leave Calcutta, the temperature and all that, and he went on a boat, and he passed away. He passed away on August 11th, 1860. So the man that was behind the income tax saw as sort of his last gasp of life the enactment of the income tax, and it was put in place. Now, but because of this concern of an unpopular tax, when it was one of the things that was added in council was it wasn't a tax that was just without an end. It had a specific sunset date. And so the Income Tax Act of 1860 was sunsetted to end in 1865. Now, this income tax, and this is going to start sounding familiar, so that's kind of the background. Now I'm going to get more in terms of what the Tax Act covered, how it was enforced, and that sort of thing. And in this part of the lecture, this will sound, I think, more familiar to you, unless you're wonderful historians of income tax. The Indian tax was schedular, or I think you say scheduler. I say scheduler, dividing all taxable income sources into 4 schedules. The schedules cast a wide net and were based on what we know as resident and source-based principles. The first schedule was based on the source principle, taxing profits arising from land or houses in India. The second schedule imposed tax on interest and dividends payable in India to a resident and income payable to non-residents that's sourced in India. So you see these concepts that we wrestle with today, we'll wrestle with and put in place in 1860. You know, and so a lot has changed, but a lot hasn't changed because we still debate these same words. The third schedule concerned annuities and interest payable by the government of India, and the fourth schedule concerned income from employment. The rate of tax was 4% on individuals and companies, and in one sense it was kind of progressive in the sense that persons that earned below 200 rupees were not liable to tax, but those that earned 200 or up to 500 were taxed at 2%. So that was a bit of a progressive rate, but not. Those numbers with the inflation that we've had since then sound like they're nothing, but I'm sure back then that was more meaningful. Now, occupiers on agricultural land actually engaged in farming were exempted from tax if their annual rent that they paid for farming was less than 600 rupees per year. And those who rented land from the government above this threshold were deemed a deeming provision in the 1860 Act to make profit amounting to 1/3 of their rent. So their rental expense, the law said that 1/3 of that would be deemed to be a profit, you'll be taxed on 1/3. Very simple, but you know, that's the way they did it. So very, very administrable. Now, government and charities were exempted, but to do that, you had to go through, it had to be approved. There was an approval process to have the charities exempted. A company was defined as any society, association, fraternity, or partnership of any kind, whatever, of or carried on by more than 6 persons. And the management of these institutions or these enterprises had to file tax returns on behalf of their companies. Now, so they put in place a set of rules saying that you're going to have to file returns in 1860. Now, how did they go about doing that? They didn't have the internet. They didn't have newspapers. Well, they did have newspapers, but how did they communicate this broadly? So the first signs of this new income tax were printed in large notices at police stations in Urdu, Hindi, and English. And they were placed at police stations as well as other conspicuous places, informing the public that they were required to submit a statement of income from all schedules to local assessors. Now, upon receiving these statements, the assessors calculated the tax owed. So unlike in the United States where it's been a self-assessment system, here it was an assessment system. So you submit the return and this is very familiar stuff because I know that's familiar these days. But here's the thing, the assessors themselves had very wide discretion to re-estimate and surcharge taxable income on the basis of a sum, and this is, I'm now quoting from the law itself, and quote, the assessor could make an assessment based on, quote, the sum on which he, of course, the assessor had to be a man, but that's a different set of issues, on the sum on which he shall consider the person making such return ought to be assessed. So in effect, it was up to the assessor. He got the return, looked at it, I don't think that's right, and he comes up with his own assessment. And you know, I mean, and there was another phrase in the statute saying that a surcharge on penalties for false returns could be imposed on the sum as the assessor thinks fit. So these wide powers were not unfettered. There were some limitations on them. Taxpayers could appeal the assessments. They could adduce evidence, bring witnesses to support a lower assessment, though they had to pay the tax in the meantime. That's also familiar in many places. They could be assisted or represented by other individuals, but they could not have legal representation. That's interesting, isn't it? They could not have legal representation. Now, suffice it to say, the tax returns were unpopular. No one liked to file a tax returns. It was new. I mean, they were asked for all this information about their income. And it made, generally speaking, this is a quote from an article here, Indians suspicious. Now, there was a report back to the UK House of Commons saying that as a general rule, tax returns are conspicuously and shamelessly false. So, you know, because of these difficulties of filing returns, giving the tax assessors authorities to say what the numbers are, they came to the conclusion that for the remaining 5 years, they would base the assessments based on the 1860 numbers. Now think about that. They've got a 5-year statute. Things change over 5 years, but because of difficulties, they're going to sort of freeze it at 1860. And think about this. I guess one of the things I didn't mention, if you're under Schedule 3 and things were payable by the government withheld your tax. So there was a withholding system back there. You know, when you had annuities and interest paid by the government, there was withholding subject to that. But these returns were based on 1860 numbers, so it was inherently unfair. You know, the administration of it, regardless of how wonderful the statute was, the administration of this law fell down very, very badly. It was very, very unfair and very difficult, and people thinking that and it was so unfair that the microphone objected. Another thing that was inherently unfair about all of this is that if there was fraud that was alleged and prosecutions could be had, there was differentiation between the penalties between Indians and non-Indians. If you were a non-Indian and you committed a tax crime in India under the 1860 Tax Act, then your penalty was less than if you were an Indian. You could be jailed if you were an Indian for up to 14 years. If you were a European, still a long time, you could be jailed for 10 years, but that's 4 years difference. And it was administered badly and it was unfairly written, that part. There's no question about that. So at the end of this 5-year period, they had estimated when this had begun that they were going to generate between 15 and 20 million pounds over the 5 years. And as it turned out, they actually collected 8.7, which is still kind of an impressive number that they got. Oh, thanks. I hope those of you that have listened to YouTube could read lips. The effect of this was less than expected, but it certainly stirred up a lot of activity and put in place a system of income tax that was just effective for 5 years. Now, the arbitrary assessment actually carried the seeds of the decay of this law. And part about being the past is prologue. Professor Jha, who used to teach here, he and Mukesh Bhatani wrote a book called Taxpayer Rights, Deciphering the Indian Charter. Now, one of the reasons there's been so much focus on taxpayer rights is not to say that modern tax laws in India have been good, but I mean, if you go back in time and you look at how that law was administered, it was very, very arbitrary and unfair. And so there's been a lot of effort in the subsequent years of making taxpayer rights more vibrant and making them more fruitful. So if those of you that have not had the chance to see Professor Jha's book and you want to know anything more about taxpayer rights and deciphering the India Charter, I would recommend this book. And there are a few pages in the beginning about some history of all of this. It doesn't go back to 1860, but the seeds of decay of the 1860 law and the seeds of this book are in the 1860 law. So the past is prologue. So enough about the 1860 Indian Income Tax Act. And now what I'd like to do is go around to the other side of the world, to the United States, but the same time period. Now, those of you that are familiar with U.S. history will know that in 1861, the United States had a civil war with the secession of many southern states. They referred to themselves as the Confederate States of America. There had been economic issues in the years leading up to the war, and the federal government already at that time, before the war started, had a dire need of funding. I mean, the funding there was basically tariffs, customs duties, and same worldwide. That's how government at that time, before income tax, got revenues, and of course still do these days. But after a series, after the first attempt to fund the war in 1861, the economic conditions in the North actually worsened. I mean, you can imagine a civil war in your country will adversely affect the economy. And so the Congress, such as it was reduced because the Southern members of Congress left Congress and started their own government in Richmond. The government that was in Washington, D.C., enacted the Revenue Act of 1861. So there's one uncanny similarity. Funding needs for violent actions here in India and also in the United States in the 1860 timeframe required enactment of new laws. Here it was the income tax, and in the United States, the Revenue Act of 1861 levied the first ever income tax on American citizens. The act imposed a tax of 3% on incomes over $800. So at that time, it was just a flat rate, $800, 3%. And remember, I said the 1860 Act was 4%, so very similar there. Now, after a series of indecisive battles in 1861 and the first half of 1862, it became very clear that the war was going to last longer. I think, as what happens in a lot of wars, people think, oh, this is going to end real soon. And then it gets really, think of Ukraine. I mean, a lot of people thought, well, I'm not going to get into Ukraine. I mean, because that's very complicated, and that's beyond this lecture. But it's lasted a long time. It's lasted too long. And what's happening in Gaza has lasted so long. These things just seem to last forever, and they're tragic. But to carry them out, governments need money. And so in the 1860s, both India and the United States thought, well, let's try the income tax. And so that's kind of the birth of the income tax, the reason, the raison d'etre for this in both countries. But after the 1861 Act, there was a series of battles that went badly for the northern side. And so Congress actually then very quickly passed the Revenue Act of 1862. So less than 1 year later, and before the first tax had ever been actually put in place, because when you have an income tax, you have it, there's a lag, you don't just get it immediately. Before that came into place, the 1862 Act was enacted, and that's why that's on the first bullet point under the United States, the 1862 Civil War income tax. And that replaced the 3% tax on income above $800 under this 1861 Act, with a progressive rate such as it was, with 3% on incomes between $600 and $10,000, and then 5% tax on incomes over $10,000. Now, this was passed as an emergency measure, so people in Congress sort of thought, this is not going to be very popular. We want to be reelected. We're going to just have to do this because we have to do it. And so it was passed with the intention of being a temporary measure, but it did not have a sunset date per se as the Indian income tax did. Now, some would actually argue, and there's a very good book written about a couple of years ago called Ways and Means, and it's about the Civil War in the United States. It makes, part of the point that it makes is that one of the reasons that the North won the war is because they had an income tax, because they had a source of revenue, and the South, this is obviously an oversimplification, the South was just printing currency, and inflation ran rampant in the South, and they couldn't carry on the war very well. And so that's that. Now the Civil War taxes were not immediately repealed at the end of the war, but were carried on until 1872, when the Ulysses S. Grant administration sponsored the repeal of most of the emergency taxes. So now, just to have some more comparison between the actual administration of the two acts, these two 1860-ish acts. The act in the United States made it the duty of any person liable to an annual tax to file a return with an assistant assessor of the division in which he or she resided before the first Monday in May. And failure to file resulted in the assistant assessors estimating the tax. So there again, you have very arbitrary activity. You have these rules, but you give the assessors great power to assess the tax. But in fairness to the people that are putting these in place, they didn't have any administrations to deal with. They had to do something. And so what they did was give the local official, the man in charge, the power to make a determination. And on the return itself, it specifically said there can be no appeal. Now, I cannot find any sort of criminal jail time for failure to file honest returns in the research that I've done, unlike the British Act, which had 10 to 14 years. But nonetheless, if the assessor found that the return did not reflect the true numbers, he could assess a tax equal to his tax plus 100% penalty. So he could double it. So it could actually be quite substantial. Now, another sort of similarity between the two, and it's kind of an interesting fact, is that the 1862 tax law did not exempt federal salaries. And so the Treasury Department deducted tax, withheld tax from the paychecks of federal salaries. And that's very much like the government here in 1860, where they withheld tax on annuities and interest. So withholding was put in place rather early, but on government payments. And we all know now that withholding is kind of the cornerstone of modern compliance. And so many different actors in the world now have to withhold on things, not just the government. Another interesting fact that I found out when I was looking at this that I did not know is that in the United States, under our Constitution, there's a separation of powers between the executive branch, the legislative branch, and the judicial branch, and they say they are three equal separate branches of government. And the Chief Justice of the Supreme Court, after his paycheck had been withheld, wrote a letter to the Secretary of the Treasury saying that this was a constitutional violation of the separation of powers, and the Secretary of Treasury forwarded the letter to the Attorney General, and as a result of this, all federal salaries were exempt from taxation in the 1864 revision of the Act. So that was a very interesting reaction, isn't it? The one part of government saying, you can't withhold on me, and so the answer is, well, let's not withhold on me either. So I don't think that was quite fair to the other taxpayers, because there were a number of taxpayers around the country, and it did raise a rather sizable amount of tax in those years. There was one merchant that actually paid in 1 year in this time period $400,000 of tax. So I mean that's incredible. But and at that time. This was all public, so taxpayers, their tax, that kind of thing was made public, and so he was seen to be a national patriot because he paid so much tax. Now, this was abolished in 1872, but an attorney who was subject to this tax in Illinois had paid tax in 1865, but he refused to pay tax on his professional earnings. And he litigated this, and it went to the U.S. Supreme Court. And the U.S. Supreme Court in 1882, I believe it was, held in a unanimous decision that the tax was constitutional. Now, the attorney had said the Constitution does not permit the federal government to impose direct taxation. And nonetheless, the Supreme Court in 1880-something said the Civil War tax was constitutional. It was not a direct tax. It was an income tax, but they said it wasn't a direct tax. So that then brings us, so that's sort of the big stuff on the first 2 points. That then brings us to the 1895 Pollock versus Farmers Trust and Loan, because the United States needed revenue later and enacted an income tax that was found to be unconstitutional in 1895 by the Supreme Court, in this case, Pollock versus Farmers Trust Loan and Trust. And it was found to be unconstitutional because they determined that the income tax was a direct tax and unconstitutional. So you had one Supreme Court a couple decades before saying it's constitutional, unanimous decision. Then a little bit later, an income tax is unconstitutional, 5-4 decision. And then that caused the amendment of the United States Constitution in 1913 with the 16th Amendment. And with the 16th Amendment, it said income tax can be imposed by the federal government, and that then became the income tax that we now know and love in the United States. So, the other bullet points on this in large measure are activities that occurred in the international area. In India, for example, there was an income tax treaty was entered into, a bilateral income tax treaty was entered into force between India and Greece in 1965. And in 1989, India signed an income tax treaty with the United States. And on the other side, you can see that shortly after the 1913 16th Amendment and the beginning of the income tax, the United States imposed tax on a global basis, meaning that its citizens and companies were subject to tax on income wherever they earned it around the world. But they also enacted a foreign tax credit, meaning that if you paid a tax in another country, you could credit that tax against U.S. tax. And that was something that was done in 1918. Now, in 1928, the United States enacted transfer pricing concepts, and we are all familiar with transfer pricing. I think we have a distinguished professor in the room today that teaches transfer pricing here in India. and transfer pricing was introduced here in, I think, 2001. So there's a bit of timing difference there, but similar activity that transfer pricing is necessary, because without it, you will have commonly controlled entities shifting income in a way to minimize tax in a non-arm's length way. And what the transfer pricing rules try to do is to say that related parties should deal with one another as if they were unrelated, and that the sales and services are done as if they were independent of each other and at arm's length. In 1928, we had the League of Nations Model Tax Treaty. The United States was involved in those discussions, but did not actually approve the League of Nations when that came up to be. It did not pass in the United States. There were also in the 1960s with President Kennedy, so-called Subpart F deeming provisions, another deeming provision. You know, I was talking about in the 1860 Act, they deemed the profit of a farmer to be, that if he paid more than 600 rupees a year of rent, they deemed that the profit was 1/3 of that rent, that whatever he paid was a profit. So in the United States, they enacted deeming provisions on foreign earnings of controlled foreign corporations. So if a U.S. parent company owns foreign controlled corporations, income earned by the certain types of income earned by the foreign corporation could be deemed to have been distributed to the U.S. parent, even if they were not paid. So deeming provisions there. And there's a bunch of other stuff here. I'm not going to go through all of it because I'm getting out of breath. But you know, I think the part that's in yellow down at the bottom talks about the activities that were done at the behest of the G20 and the OECD in 2013, when the base erosion and profit shifting work commenced. And in 2016, there was the inclusive framework that was established, and India and the United States were prominent participants in that, and they talked very, very much about that. And of course, in the digital services taxes, and the fact that in January of 2020, there was a statement by the OECD and G20 inclusive framework on a two-pillar approach to address tax challenges arising from the digitalization of the economy. And my concluding remarks at this point is that we started out talking about how, under times of stress, India and the United States enacted income taxes, kind of preliminary income taxes that have become sort of the cornerstone. When we think of ourselves as a U.S. citizen or as an Indian, we probably think of ourselves in part, at our age, we probably think of ourselves as being taxpayers, because we know we not only pay sales taxes and GST and things like that, but we also pay income taxes. And so it's part of who we are, and it started back in the 1860s in both countries, and now in more modern times with the digitalization, where we are all, if I left this room in 2 minutes, everybody would be doing this, right? The digitalization of the world. That's where we are together as countries, and these countries have come together to determine what would be a fair and appropriate taxation of revenues that are generated in the digital economy, because the 1928 League of Nations Model Tax Treaty basically requires a physical presence in a country before that country can tax the overseas activities. You don't need a physical presence these days to generate money out of any country, and so these activities in yellow are in large measure a way to try to determine what are fair and appropriate taxes in the digital economy. Both countries have been active participants in these discussions. And what I'm going to conclude with is that we've just, in the United States, had a release of the President's budget for the upcoming fiscal year, and there was absolutely no mention of these ideas in his budget. And my understanding, and I'm going to ask someone else to speak about this who's more knowledgeable than I am, here in India, also an active participant. I think there's been a budget released in the last couple of weeks, months or so, very recently. and I believe there's been no mention as well. So in that sense, I think I've been very long-winded, but I hope I've demonstrated to you that there have been points in time where there have been uncanny similarities in the development of tax in the United States and in India. And so in that sense, we are together. So thank you. That's it. That's all I'm going to say. I'll be happy to answer questions. So, do you want to make an introduction or something? Please.
I just wanted to ask Professor Hitesh to actually expand on
Well, maybe at the end, if we have any questions,
Sure.
then I come back up.
Good afternoon, everyone. Thank you, Professor Parnell, for this, bringing out the similarities between just two jurisdictions when it comes to income tax. But I would say these similarities are not just limited to jurisdictions, but if we see how the organizations and how the policy development of tax happens, then also you'll see a lot of similarities. So when it comes to about taxation rights, if a country is getting more taxing rights by a certain measure, they would jump first hand on it to impose that taxation policy. Example, equalization levy. We have digital services tax. India jumped the gun on it in 2016 immediately as we received, as the 2015 first action report of OECD was published, where they recommended equalization levy with caveats, which was completely ignored by India, and immediately introduced the equalization levy, and also bringing in change in the domestic law for significant economic presence, taxation of digital businesses on basis of their economic presence in India. But the US was silent on that. The US didn't take any steps towards it, but instead challenged the equalization levy which India imposed, being unfair and against the treaty obligations that India has, trade obligations, and thereby going forward even to impose sanctions against India for imposing equalization levy. But when it comes to Pillar 2 discussions, that's the January 2020 statement which we had by the OECD and G20 nations, and like Professor Parnell described, that India and US both were spearheading, both were prominent partners in these discussions, but like US is silent in their budget about implementation of Pillar 2 rules, which were, the blueprint of those rules were introduced in December 2021. And similarly in India, we had our budget in 2023. We are also silent on Pillar 2. Again, a similarity. And the reason is, again, to do with tax policy. I would say here, both the countries are on the losing end when it comes to taxation in Pillar 2. So January 2020 statement was made by all the nations. We were which were very positive in implementing the Pillar 2, which focuses on introducing minimum taxation on all multinationals, in scope multinationals, and trying to achieve effective tax rate of 15%. But on the other hand, when December 2021 blueprint came out, in my opinion, the QMDTT was a bit of a surprise. Qualified minimum domestic tax was a bit of a surprise there, because that was not in the discussions prior to December 21 blueprint. And India, which was focusing on getting some rights of taxation when it comes to minimum taxation, would be left out, because this right of QMDTT, qualified minimum domestic top-up tax, was given to the jurisdictions where the constituent entity or the entity which is being taxed at less than 15%, that state has the right to tax, to apply the top-up tax to achieve ETR of 15%. So again, reallocating the profits to the investment hubs like Netherlands, Ireland, and over and above we have substance-based economic exclusion, income exclusions, which are carve-outs, which effectively reduces the income which is subject to Pillar 2 rules. So there I think India and US has a similarity, that these rules, implementing these rules as is in the domestic law right now, would not be that beneficial, and there needs to be still rethinking to be done on this. But while the rethinking is being done, there are other countries which have already imposed Pillar 2. So my question would, to end this session as well, and my question to you all generally would be, if we don't impose Pillar 2 recommendations, if US also doesn't impose Pillar 2 recommendations, which includes bringing significant change to their guilty provisions and also significant changes to their CFC provisions, controlled foreign corporations rules, what will happen to their tax base? It will affect the present tax base as it is right now as well. What do you think, Professor Pani, about it? If we don't bring the Pillar 2?
Well, I mean, I think that in order for the United States to comply with Pillar 2, it will need to change its law. And I don't think that there is appetite at the moment for a law change because the global tangible loan tax takeout will have to change from the overall country rule. And so I'm saying that there's no appetite for to change those rules. So unless there's a reason to change, it's not. I just answered the question. But I think that if other countries do, and U.S. companies are adversely affected because they are taxed with no tax by these other countries that have a stock ability to, then those U.S. multinational companies will make their complaints known to the U.S. Treasury and the U.S. Congress, and there could be a chance of a change of the filthy rules to make them compliant with Pillar 2 by changing them to a country that may there's a lot of steps that we can go.
I agree. So thank you all. Thank you, Professor Arji. I think we will have a lot of similarities in the future as well. Considering that it's tax based or other than. Thank you.
Do we have any questions?
Thank you, Professor Archie and Professor Yogesh, for expanding on the topic, and we really got to learn a lot about it. Especially, I must say that the comprehensive analysis about similarity provided us with valuable insights. And personally, I got to learn a lot. There were a lot of patterns which I did not see, especially the war component between the two factors and how it helped in the commencement of income tax act in both countries. So, we would like to, okay, so we already have a question.
The answer is I don't know.
Thank you so much, Professor, for that great seminar. It was really informative. So earlier in my taxation classes, actually, we had covered the topic on OECD guidelines and how they are relevant in today's time. A key question we came to encounter was what sort of confusion that can arise when we try to move away from source-based rules and try to incorporate rules that are more in line with the times of today, like you mentioned, of digitization. And how do you think these confusions might arise when various countries try to prop up their own personal landscapes and try to incorporate them in today's tax regimes?
I guess one thing that becomes apparent when you're looking at a blank timescape from 1860 to today, one thing that comes out rather clearly is that countries typically look after themselves first. And so the income taxes back in the beginning were for their revenue to fight wars. And then these other things, transfer pricing, that's to make sure that taxes payable and so forth. Now, when we get into the international arena, then it becomes, I believe, more of a dynamic of power politics between countries. And that's when the G20 plays such an important role. And of course,
As we all know, India was the president of the G20 until just recently, I think, end of November of 2023. And, so the nice thing that we have going for us these days, as opposed to back in the 1860s, is that we are engaged in discussions. When I say we, I mean the countries around the world are engaged in discussions. The OECD has put together this inclusive framework of many, many countries. We know that the UN has now set up the General Assembly in, I think it was December the 22nd, which, by the way, is the birth date of my granddaughter. My wife's not her first granddaughter. But on that same day, the General Assembly passed a resolution talking about cooperative tax. And so the United Nations is going to have more of a role to play. So it's going to be a combination between power politics, where countries try to protect their economic interests and protect their sources, their countries' revenue makers. So in the United States, in large measure, one of the reasons there's such pushback about all of these digital things is because, not exclusively, but in large measure, the digital companies are based in the United States, and their revenue is based in the United States. And the U.S. government and the companies say the innovation is coming from the United States, and that's what's giving the value, and that's what should be retained by the United States to be taxed. And then, of course, you have the use here that's going on even as I speak of people using the digital economy as we go on in this lecture. And that's can be seen now to be the source country of the payments of this sort of stuff. I think where it's going to, we were discussing this earlier. I mean, I think that one way forward may be, there are many ways forward, but one of the things that I've been thinking about recently is the fact that the UN has enacted or has made Article 12B a model, part of its model treaty, and if that could be made so that withholding would be done not just on the business side, but also on the consumer side through some sort of work with payment processors, that's something that might be done. And I think it is inevitable that, given the modern world and the digitalization and the fact that people pay for where they use it, there's going to have to be some real recognition of that. So that was a very long-winded answer to say that we have to keep talking. And we will. I mean, I think we're coming to the view that we need to come to resolution of this without being unfair to anyone, if that's possible. So, thank you for the question. Yes.
Taking off from the discussion the brief discussion that we just had on the OECD and the digital economy, I had a question regarding a form of investment that is crypto, which involves cryptocurrencies. And there's a lot of discussion lately, although the investments from that area seem to not be at a higher, there aren't too many people who seem to be engaging in it, but it seems to be catching up lately to a certain extent. So the question that I actually wanted to raise was regarding taxpayer rights with reference to cryptocurrencies and their investments, and whether tax policies can very firm or rigid tax policies deter such investments, or is it even necessary for that matter? And what happens to taxpayer rights in such circumstances?
Well, I think that on digital currencies and digital taxation, actual things, I think I'm going to ask my colleagues to make comments on that, if you don't mind. If you want to talk about that a bit more, so either with you would be appreciated.
Can you please repeat what on digital currency you were talking about?
So we did touch upon the aspects of taxpayer rights as such. Now, cryptocurrencies are not, it's sort of catching up. It's not at the peak as such, but it's sort of coming into the purview, and India is among those countries with one of the highest tax rates for cryptocurrencies. So would such rigid tax regimes or tax policies deter such investments, and would that indirectly affect the income earning capacity of an individual? And should it be the case, or will it have a negative impact going forward? And is there need to relook at all this?
So I would like to take the same words which I had from our colleague here. History is the best teacher for us. We should take lessons from our past. Whenever we have tried to bring in a law which we find is a bit arbitrary or not in line with the policy or how economic advancement is going, we have always received flag against it. So if you know, we have liquor prohibition in Gujarat, but we know the reality how it happens. So even if we bring out such provisions of tax, highest tax rate for cryptocurrencies, trying to better the investments in cryptocurrencies, but on the other side, if we see the advancements in cryptocurrency, they are not only used for currencies. They have underlying technologies which are being used by various multinationals, yes. If you see the advancement growth in crypto assets sector, and that's why I call it crypto assets rather than cryptocurrencies, because the underlying technology was introduced as currency Bitcoin, but now we have so many different assets which have different underlying technologies, use cases more than what a currency is for. And I would say that imposing a provision like what we have in the Income Tax Act right now is trying to disincentivize people to invest into crypto assets without knowing. One of the major reasons is not only that the government doesn't want you to invest, but also buying time by the government so they can understand how to regulate it properly before reducing the tax rates. Because there has been a lot of scams surrounding crypto assets, surrounding exchanges of crypto assets. So they just need time as to what works in the regulatory sphere before we understanding how to tax them.
Just one more question. So again on these lines, in the US, from what I remember, it is such assets are treated at par with property and the likes. So the treatment also seems to be varying. Now we're going to come up with a policy which is essentially for a global facilitate global transactions because crypto is cross-bound country borders. Would this become a question because in one country it's a property as an asset, and the other country is just an invisible code for that matter. So how does one go about imposing some system to ensure that it can be practiced?
So for taxation aspect of crypto, this is something which was highlighted in the G20 meeting in 2023. Where they came out with a statement saying that there's a need for a global coordinated effort for properly taxing the crypto assets, and it was in line with the digitalized economy because, like I said, you can cross the borders with crypto very easily, and that's where the regulation sphere has to think about as to how to gather information when the crypto is being traded outside India or being traded inwards into India. And then the classification, whether how it is classified for taxation purposes, that's something which I would say is a sovereign matter. And even if there is distinction between how US treats crypto assets, India also treats crypto assets to be as property. The only difference is India has a specific provision which taxes it at 30%. Like, take example of, let's say, where in one country Bitcoin is considered as a legal tender. Then that creates a problem because under FINMA it would be recognized as a foreign currency in India, and if trading in Bitcoin in that country would result in more taxation in India being foreign currency. That's one sphere which has to be decided, again, like I said, globally, through coordinated efforts, how that has to be treated for the treaty purposes, for convention purposes, how the definitions in the treaties to be included, to exclude crypto assets from currency part and include in a particular provision, like let's say capital gains. And then they may be taxed as per special provisions in India at 30%. That should be fine. Anyone else?
Very pleasant evening to Professor Archie and the respective dignitaries of the IS and other IS. My question is very particular, like the situation may change. What is your viewpoint on the recent MFN case judgment by the Honorable Supreme Court of India? Like, has it changed the positionality of international law in that context? And the same has been subject to review before the Supreme Court itself. Like, how challenging or basically changing the international scenario before in India, basically.
Well, since you're asking about India's Supreme Court case, I'm going to let the Indian solicitor answer that.
If anyone recent MFN case judgment, like how is it challenging the international context in terms of taxes?
The different case that meant for OECD benefits. OECD
For the PTWs and the question of the interpretation of PTWs, question is what is your opinion on that?
I don't have the original opinion, but it depends on how you interpret a treaty. Whether you want to have your static approach that when the treaty was entered into should be interpreted for that time, or do we dynamically apply it that the provisions of the treaty are relevant in the present time as well. Right? But at the same time, we have to understand the intention when the countries sat together for at the negotiating table, deciding on a particular clause. So when an MFN clause is decided by like India deciding to give up its taxation rights in favor of another country, which and then agreeing that okay, if I have agreement with other OECD member states and there is a beneficial provision there, I will also grant you that beneficial provision. I cannot foresee a future then that okay, there might be some other country with whom I already have a good treaty, not after they become a member state, but with whom I already have a treaty, and then they become a member state of OECD, and then I cannot foresee that I'm ready to give up the benefits to other states as well, with whom I never, I could never fathom that 5% tax would ever be coming up in the OECD member states. So, while these discussions before Supreme Court was already going on, I was again of the opinion that yes, as when it comes to obligations of a member state in a tax treaty interpretation scenario, then we should also look at the main intention underlying the agreement for giving up the taxation rights. This is something which is also there in Azadi Bachao and Thomas.
I'm just going to add something, not disagree with anything that you said, but I'm just going to say that in the United States' experience, tax sparing came up with the Pakistan-U.S. treaty in the 1960s. And there was a professor, there was a member that he worked in the Treasury Department for a long time, and he became a professor at Harvard Law School. His name was Stanley Surrey. And he was of the very strong view that tax sparing is something that a country should never do. And he was very persuasive, and the United States has never entered into a tax sparing a treaty with a tax sparing provision in it. And these treaties that sort of say, well, if we agree something with somebody else later, we'll agree it with you now. I mean, it's too movable. I mean, you're not really sure. These are bilateral treaties that are trying to morph into
one side is trying to morph them into a multilateral treaty. And that's something that I think the United States would be very reluctant, and has been very reluctant to do. And so we haven't been in that context that the Indian Supreme Court has had to decide.
So as Professor said, that US wants to tax its the big corporations that are resident there because of the technologies that are there and all. So how will Pillar 2 affect this? The Pillar 2 says the source countries can tax it, another country can tax it, Pillar 2 is not applied by the US. So where US stands? Will it take up Pillar 2?
I think it may be forced to agree to Pillar 2, but it's not going to go there willingly, even though it's been in the conversations and trying to tell everybody that we need a global minimum tax. To be quite direct, I think the reason the United States wanted a 15% minimum tax was so that there would not be countries that U.S. companies would try to go and minimize their tax. It wasn't a way, it was a way to, I think the United States was viewing it as a way to protect their revenue base, not to lose it. But the way this is developed with the top-up taxes and everything is that since countries can actually tax U.S. companies in certain circumstances if those countries enact Pillar 2, then in the event that there is a significant enough tax burden on those U.S. companies in that circumstance, there may be a sufficient enough focus of those countries to actually persuade the Congress to change the guilty rules from overall to per country and then comply with Pillar 2. And so that's the only way I see it happening, because again, it was done to protect the revenue, not for the U.S. to lose revenue. And again, as I said, at the end of the day, what this sort of teaches us at one level is that every country looks out for itself. And the United States is pretty big at this, and they look out for themselves. So, but they try to be agreeable on many things as well. So perhaps that sounds like I'm speaking out of both sides of my mouth. I'll leave it there.
Do we have any other question? Okay, I'll take one question because we don't have that much time.
We have to go to the airport at some point, my wife and I.
Hi, Professor. The similarities that you presented that the taxation legislations that have come out of both India and US, they have started from conflicts, if not wars, like the Civil War or the strike for independence in India. And with the military-industrial complex, which has now been globalized, and not just the globalization of the military-industrial complex, because like as you said, governments need money to carry out atrocities, right? And they also profit from atrocities that are currently going on. There are a lot of like military-industrial complex has been given a lot of government subsidies. For example, you have entire lobbies for ammunition manufacturers in the US, and also you get manufacturing and industrial subsidies as special economic zones which promote quite primitive accumulation of land and resources from people and indigenous owners of resources. So my question is, can taxation be seen as like a tool, like for example, Bhutan has this tourism tax because they have a lot of their resources and their ecology is very, very sensitive. So if somebody wants to enjoy the benefits of tourism coming out of their country, they have, I think, $200 or $250 a day of tourism tax, which is like the highest in the world. So my question is, with like the rise of militarization and industrialization and the profiting off of it becoming the norm within international governments, can tax be seen as like a tool to reduce such extreme extraction of resources and
That's a wonderful question. That's a very good question. It's a question that I think that a lot of us think about a lot. The taxation could be so much more fair than it is today in so many different countries. but it has morphed over time because of special interests that have the wherewithal and the ability to influence legislation as it's enacted in not only democratic countries, but in countries around the world. And so what I would like to see is, is a system, are systems of government that did not have so much influence by specified persons that it be more representative. Now that's unfortunately very, I shouldn't say unfortunately, it is very idealistic, but it is something we should strive for. And the first thing we need to do is again my view, the first thing we need to do is in those systems where we do have democratic governments, we need to make sure that the funding of campaigns of those that are elected to office that make these decisions are not overly influenced by these interested parties. In the United States, there was an attempt to there was a box on the tax return that everybody could check if they wanted to, and it said, would you contribute $3 to the presidential election campaign? And the idea behind that was that the special interest stuff would go away and they would be funded by all taxpayers in the United States. That didn't work, and unfortunately now large contributions can be made through super PACs in the United States, and those donors are not identified. I believe that's true in India, that donors are not being identified when they make contributions to political purposes. And so the problem is the same people that would need to change the rules on how campaigns are financed are the same people who are being financed by the current. So it's going to take sort of a sea change to get this done. But what I think we need to do is to get representatives that are not beholden to any particular group, but are beholden to the economy, to the country, to the people of the country, to the greater good, to the collective good. And then perhaps we could see better tax laws, because after all, tax is what gives government the wherewithal to build roads to carry on a civilized world. So it would be wonderful if we could have fair taxes. I admire your idealism. Please keep it up.
Good evening, Professor. I will take more of the time. I have just a very simple question.
I bet it's not simple.
So there has been, we've been talking a lot about the OECD, but of late the UN has been, pushing its own tax reform. I'd like to not go with the generality of it, but just the US perspective. One side, the US does not go forward with Pillar 2. They have not yet implemented it yet. On the other side, they have not supported the UN tax reform either. So where does US stand between the adoption of the global tax codes with respect to the UN side versus the OECD side? Because one side they're not accepting the OECD, on the other side they're not accepting the tax reform suggested in the UN. So what's the perspective of the United States in this?
Well, firstly, I cannot speak for the United States. I can only speak as one person. It is true to say that the United States, as well as a number of other developed countries, voted against the UN resolution on the 22nd of December. And so, nonetheless, the resolution carried 120, I can't remember the exact number, but a large majority. Now, there are those in the world that sort of say the problem, and I'm putting that in quotes, with the UN is that it's a majority-based sort of system, and it's not a system that is majority-based in terms of the economics of the world. Because if you take the G20, there are 20 countries. What is that of the global economy? That's, I don't know the number, say 80%? Okay, so a number of the G20 countries voted against this resolution because they were working on this OEDC thing, but yet the UN goes ahead with this majority-based thing. So you have that dynamic. You also have the reality that the United States, as well as a number of other countries, have now seen Pillar 1 as being very problematic from so many different perspectives, and it's gotten so complicated that it's going to be very, very difficult to enact. So it's my hope as an individual that the introduction of the UN in this discussion is a positive thing, because it may move the discussion off of the complicated solution onto something that's more administrable. Because one of the things that we've seen from 1860 to today is that if you have a tax law that's not administrable, that it's too complicated, that people don't like it, it doesn't work. And so what we need is something a bit more simplistic. I think the UN, Article 12A, 12B, it has some simplicity to go for it. The problem, of course, is that that's based on a bilateral sort of thing rather than multilateral, so that perhaps the UN can sort of morph that into a multilateral approach. And again, I think I touched on this a minute ago. I think that 12B would need to be expanded into having withholding on the consumer side as well. But so what I personally think is that the United States may be convinced that in view of all of the various tensions and forces on it, that the best thing to do would be to go with a more straightforward solution rather than having digital taxation morph around the world, because it was starting to morph already, and that's what caused a lot of the OECD work. And now we're sort of at a standstill there. So I remain an optimist, because I'm an optimistic guy, and so that's what I hope happens. Who knows? Thank you all. I think we're going to have to stop here because we got to go to the airport. Thank you.
Thank you so much, Professor Mukarkar and Professor Ritesh. Before we end the session for today, I would like to call Professor Ritesh to give memento to Professor Parner and Mrs. Parner for finding time and giving such a knowledgeable lecture. And Professor Thank you everyone for coming, and thank you logistic team and the audiovisual team to making sure that this goes smoothly.